Welcome, everyone, to this deep dive into the world of investing. We're going to be taking a look at Louis Navellier's book, The Sacred Truths of Investing. It's a fascinating read. He doesn't just talk theory, he actually highlights specific stocks that have yielded some truly extraordinary returns.
And I think what makes Navellier's perspective so unique is his unconventional path to investing success. I mean,
Yeah.
he didn't start on Wall Street. He was a bricklayer
Real.
early on, and that experience, working with those patterns really instilled in him an appreciation for numbers and their significance. And then later on, he got access to mainframe computing,
Yeah.
way before it was common, and that allowed him to kind of pioneer these really innovative investment approaches.
Interesting. Okay, so let's jump into the first sacred truth that Navellier talks about,
Mm.
optimism. He really believes that having a positive outlook is super important for anyone who wants to be successful in investing. And he uses Google as a great example. Remember back in 2021 during that tech downturn when Google's stock plunged like 40%? I mean, there was just so much pessimism about their future.
Right. And those who held on to their Google shares though, right? They had that faith in the company's long-term prospects. They ended up reaping a remarkable return.
How much are we talking?
We're talking 2,400%
Wow.
on their investment. Navellier actually backs this up with a whole century's worth of data from the Dow Jones Industrial Average. His analysis shows that even through world wars, recessions, all those unexpected crises, those who maintain that optimistic stance stayed invested. They ultimately came out on top.
That's pretty compelling, especially when we think about all the pessimism surrounding that potential recession back in 2023.
Mm-hmm.
I mean, analysts, media outlets, they were almost certain
Oh, yeah.
that a downturn was coming, and so many investors, they panicked.
Exactly. And they missed out. Think about those investors who went running to those low-yield treasury notes because they were scared. They missed out on some serious gains. The S&P 500 during that same period delivered a 23.5% return. Navellier's message is very clear. Letting fear control your investment choices, well, it can lead to missing out on big opportunities.
Makes sense. Okay,
Mm.
so let's move on to another intriguing idea that Navellier presents, the concept that the United States is like a unique haven for investors. He believes there are inherent advantages to engaging with the U.S. market that go way beyond just GDP growth.
Right. He talks about this idea of self-perpetuating growth within the U.S., and it's really fascinating. He points to the massive investments, close to $800 billion every year, poured into research and development in the U.S.
Wow.
And this constant drive to innovate fosters this culture of entrepreneurship. I mean, think about it. Groundbreaking technologies like GPS, airplanes, the internet, all born in the United States.
And it's not just about inventing new things. It's about the sheer scale of these American companies. Navellier highlights Broadcom. This company was founded in 1991, and today it has a market capitalization that's larger than the entire GDP of Norway.
It's mind-boggling. And the U.S. stock market, it's the biggest in the world. It dwarfs the combined size of the next four largest markets.
So for investors, that's a
It's-
pretty significant advantage.
It is. It means you have this unparalleled array of investment options right at your fingertips.
Okay, so now let's dive into the great wealth transfer. This is something that has big implications for you, our listener, and really for investors all around the globe.
So as baby boomers enter retirement, right, they're starting to transfer trillions of dollars in assets to the next generation. This massive flow of capital, well, it's inevitably going to end up in the stock market, and that's going to reshape the entire investment landscape.
And this transfer is happening at the same time that the number of public companies is actually shrinking. We're seeing buyouts, bankruptcies, share buybacks. It's all contributing.
It's creating this scenario where you have rising demand for stocks and a shrinking supply. Right. And this dynamic, well, it could push stock prices up, and it could also make markets recover faster from those inevitable downturns. So this raises a lot of interesting questions about the best way to navigate these shifts.
All right, now let's get into the nitty-gritty of Navellier's framework for actually picking stocks. He really emphasizes the importance of fundamental analysis as a starting point. Understanding a company's financial health, that's key.
Absolutely. He breaks down those essential financial metrics, things like operating margins, return on equity. He gives some really clear examples. He talks about Supermicrocomputer, a company that saw its operating profit jump a staggering 700%,
And in just 1 year.
driven by soaring sales and improved operating margins.
That's incredible.
It is.
Okay, so Navellier is saying that a high return on equity is not the only thing to look for. It's about how well a company uses its profits to actually generate more profits.
Yeah. He really stresses that. It's not enough for a company to just be profitable. It has to be able to reinvest those profits wisely to fuel future growth. Imagine you invest $100 in a company and it generates $20 in profit. Now that profit can be reinvested to help the company grow. That's a 20% return on equity. So it's really about understanding how effectively a company can utilize its earnings to generate more earnings.
All right, before we move on to technical analysis, maybe we can dive into the world of stock charts. I know a lot of investors find this part a bit intimidating, understanding those patterns, market trends, all that stuff.
Well, it can be daunting, but Navellier actually makes it pretty straightforward. He starts with the concept of standard deviation, and he uses cipher mining as an example. It's a Bitcoin mining company, and their stock price has been all over the place, so they have a high standard deviation.
Okay, so high standard deviation basically means lots of price volatility, which makes it a riskier investment.
Exactly. And Navellier's point is you don't have to subject yourself to those wild swings when there are other stocks out there with lower standard deviation and strong fundamentals. Then he brings up alpha, which is a measure of a stock's performance that's not tied to the overall market. It's kind of like its own thing.
Uncorrelated to the market, what does that mean exactly?
So imagine you have a stock that keeps going up even when the whole market is tanking. That would be a stock with a high alpha. It's a hidden gem that shines even when everything else is dull. It's a measure of how well a stock can generate returns that aren't just riding the market's coattails.
Gotcha. And this is where Navellier's unique background comes in, right? He discovered this whole alpha concept during his college days when he was working with Wells Fargo's mainframe computer.
That's right. They had him develop an index that mirrored the S&P 500, and while he was doing that, he stumbled upon a group of stocks that consistently outperformed the broader market. Those were the high alpha stocks. They had this ability to deliver returns no matter what the market was doing.
Interesting. So how does Navellier put it all together? I mean, fundamental analysis looks at a company's financials, while technical analysis focuses on those chart patterns and trends. How do you use both to pick winning stocks?
He uses a tool called the Navellier Portfolio Grader. It evaluates stocks based on both fundamental and quantitative metrics, basically gives each stock a grade from A to F, so it takes a lot of the guesswork out of the process.
That makes sense. Can we see some examples of how this framework works in the real world? Like, how does Nolier use it to find those promising opportunities?
Sure. Let's look at homebuilders, ADRs, and buybacks. Homebuilders have some inherent advantages. They have pricing power, and they can choose which markets they want to operate in.
And their earnings growth has been fantastic. The top 5 home builders have averaged a 23% annual earnings growth over the last decade.
That's phenomenal. And part of that growth can be attributed to their share buyback programs. They're steadily reducing the number of outstanding shares, which boosts the earnings per share, and that drives up the stock price.
Okay, ADRs. American Depository Receipts. This allows U.S. investors to tap into global growth by investing in companies that are based outside the United States. Navellier talks about Alorum Technologies as an interesting case study.
Right. They're a data collection solutions provider. Their stock kind of flew under the radar for a while because it was an ADR and didn't get a lot of attention from big institutional investors.
But Navellier saw their strong cash flow and that high alpha, which signaled a potential breakout.
And he was right. Investors who spotted those signs early on saw some great returns. Now let's talk buybacks. Navellier believes that companies that buy back their own shares can create a lot of value for shareholders. He uses AutoZone as a prime example.
AutoZone has been really aggressive with their buyback strategy. They've shrunk their share count by something like 70% since 2008.
It's impressive, and it's had a major impact on their earnings per share and their stock price. When a company repurchases its shares, it reduces the number of shares out there. So each remaining share represents a bigger slice of the pie.
So when those earnings are divided among fewer shares, the earnings per share go up, and that in turn boosts the value of each share.
Exactly. But Navellier stresses that buybacks shouldn't be the only thing you consider. You have to look at the big picture, the company's overall financial health and its growth potential.
All right. Finally, let's talk about dividends, those payments that companies make to their shareholders. Navellier emphasizes how important dividends are, especially for investors who are transitioning from building wealth to generating income.
And he makes a clear distinction between high-yield traps and companies that consistently grow their dividends. A high-yield stock might look tempting at first, but if that dividend isn't sustainable, it can be a risky long-term investment.
He uses Annaly Capital as a cautionary tale. They were offering a double-digit dividend yield, which seemed amazing, but they ended up slashing their dividend and their stock price took a nosedive.
Ouch. Now compare that to FedEx. They've steadily increased their dividend for over a decade. So investors have enjoyed a reliable stream of income, and their share price has also appreciated.
Nice. Navellier outlines some key factors to consider when you're evaluating dividend-paying stocks. Things like the payout ratio, which tells you what percentage of earnings is being paid out as dividends, and cash flow, which reflects a company's ability to generate cash from its operations. Dividends are paid in cash, so consistent cash flow is crucial.
Absolutely. And share buybacks can actually act as a safety net for those dividends. If a company hits a rough patch, they can reduce their buybacks to free up cash flow and keep those dividend payments coming.
So essentially, Navellier's advice is look for companies with a proven track record of solid cash flow and consistent dividend growth. Don't just chase after those high yields that might not last. So we've covered a lot of ground here. Navellier's emphasis on optimism, the unique advantages of the U.S. market, the role of dividends and buybacks in building wealth. But I'm really curious about those companies that turn small investments into fortunes, the kind of stories that get people dreaming of financial freedom. You're talking about those 100,000% winners, right? The companies that have produced those life-changing returns.
Exactly. Navellier calls them the 100,000% club.
Love it.
He shares quite a few examples to show you just how much potential there is in the stock market. Of course, he also makes it clear that those kinds of returns, they're not typical,
Right.
but they're out there.
For sure. The one that really blew me away was Monster Beverage. I mean, they were practically unheard of in their early days, and yet they managed to deliver a whopping 56,000% return since going public. That's incredible. It just shows you the power of finding a company with a unique product and a market that's exploding.
Absolutely. It's about recognizing those trends early on and understanding what consumers want. Now, of course, these exceptional returns often come with a certain level of risk.
Right.
And it's important to remember that not every investment is going to turn into a home run.
For sure. But are there any common threads or characteristics that we can see in these 100,000% winners? Are there any clues that might help us identify companies with similar potential?
Well, there are a few things that stand out. A solid business model and consistent earnings growth, those are essential. Navellier highlights companies like McDonald's, Amazon, United Health Group, and Sherwin-Williams. They've all shown this remarkable ability to generate profits and expand their market presence over time.
McDonald's. They're a classic example of a company that has constantly fine-tuned its business model over the years, focusing on efficiency and making those incremental improvements that really add up over time. They're a masterclass in execution.
It's all about adapting to changing consumer preferences and delivering that consistent earnings growth even when things get tough economically. It's a testament to the strength of their brand and their ability to operate like a well-oiled machine.
Amazon, on the other hand, they're all about using technology to disrupt those traditional industries. They started with books and then rapidly expanded into all sorts of product categories, pushing boundaries all over the place.
And their investments in cloud computing and logistics have created a serious competitive advantage that's just solidified their position as a market leader.
And then we have United Health Group. They're a fascinating case study in growth through acquisitions. They've been incredibly successful at acquiring and integrating other companies into their operations, allowing them to expand their reach and keep those earnings growing steadily.
It just goes to show how powerful strategic acquisitions can be in driving growth and generating value for shareholders.
And of course, there's Sherwin-Williams. They've been around for over 150 years, a true powerhouse in the paint industry. It demonstrates the lasting impact of building a strong brand, cultivating customer loyalty, and establishing a wide distribution network. And they've also been smart about acquiring smaller paint companies to further solidify their market position.
It's all about those long-term strategies and a dedication to getting better every day. It's not about chasing those quick wins. It's about building businesses that can flourish for decades to come.
So we've learned so much from Louis Navellier's The Sacred Truths of Investing. It's evident that investing is a marathon, not a sprint. It requires patience, discipline, and a willingness to embrace that long-term perspective.
Absolutely. Thorough research and due diligence. Those are your companions on this journey. Navellier's Portfolio Grader can be a fantastic tool to help you find stocks with solid fundamentals and those positive technical indicators. But it's important to keep in mind that past performance isn't always a guarantee of future results.
Right. Every investment comes with risks, and it's crucial to do your homework before putting your hard-earned money on the line. So as we wrap up this deep dive, let's leave our listeners with a thought-provoking question. If Navellier could uncover companies with such extraordinary returns using his framework, is it possible for others to do the same? The journey starts with knowledge, and our listeners have taken a big step today. Hopefully, this deep dive will inspire them to continue exploring and pursuing their financial goals.
The stock market offers a world of opportunities for those who are willing to put in the time and effort and follow the principles we've discussed. So until our next deep dive, may your investment journey be filled with insights, prudence, and of course, success.